Hello everyone and welcome back to another video. In today's video, we're going to be going through Duolingo, Fours, and Brookfield Asset Management's earnings, as these companies have all reported earnings over the past week, and the price action has been kind of surprising, at least in my own opinion. And then near the end of the video, I want to share my thoughts on the market right now, what I am seeing within my own portfolio, and how I am continuing to invest. So this is going to be another action-packed video, but before we get into the video, I want to let you know that my Black Friday sale on my new 30-hour investment course will be starting on Monday. This is going to be the largest sale that I announce on my investment course for the entire year, so if you have been thinking about getting it, then there is no better time than next week. If you also want to be notified for when the sale starts specifically, then you can head over to www.danielpronk.com/course sale and enter in your email, because I will be sending out an email as soon as the sale goes live, and that way you can make sure that you do not miss it. And I will also leave a link at the top of the description, and that will just be an easier way for you to find the way to join the email list. Now, with that being said, let's head into the video, and let's start off by talking about Duolingo. This stock was a massive, massive winner from the lows here in 2022 when it was selling for about $65 per share. It ran over 700% to its peak in May of 2025 when it hit $540 per share. But now, if we zoom in, we can see that the stock has dropped significantly, and it's now down roughly 63% from its all-time highs just over the past 6 months. Duolingo has also become a very popular stock on social media, and I think that this is because some large YouTubers like Joseph Carlson are invested in the stock now. And actually, after Joseph purchased Duolingo, I got so many comments, and now I'm being asked to cover this stock all of the time. So I do want to run through the most recent earnings and explain my thoughts on why the stock could be down and if I think it is offering value. Here we can see that in Duolingo's most recent quarter, their daily active users grew 36% year over year, monthly active users are up 20%, and paid subscribers are up 34% year over year. These are very strong metrics for the overall business, but what I'm noticing is monthly active users are not growing at the same rate as daily active users. However, paid subscribers are still up significantly year over year, and that is the main metric that I would be focusing on personally. Moving on to the financial metrics, here we can see that revenue increased by 41% year over year, which is a phenomenal growth rate. Total bookings increased by 33%, and the adjusted EBITDA margin expanded by roughly 5% to 29.5%. And then this next screenshot shows us a summary of all of their financial and key operating metrics. Once again, paid subscribers are up 34%, total bookings are up 33%, revenues up 41%, subscription revenues up 46%, gross profit is up 40%, and free cash flow is up 51% to $77.4 million. So at face value, this looks like it was an incredible quarter for Duolingo. And there's not a lot of stocks in the market, especially that have reported earnings recently, that are growing their revenues by 40% and their free cash flows by over 50%. It's actually pretty rare, and I do think that this is an extremely impressive quarter from Duolingo. So then the question is, why is the stock seeing so much weakness, and why did it drop roughly 30% after reporting the Q3 results? Well, I think that it has a large part to do with the company's outlook for the fourth quarter. And here we can see that they are now expecting total bookings to grow between 21.3% to 23.5%, which is a pretty big deceleration from what the business has been reporting historically. We can also see that they're expecting their revenues to be between $273 to $277 million for the fourth quarter, which is 30 to 32% year over year growth, which is a fantastic year over year growth rate. But when we take a look at the revenue that they reported this quarter, it was $271.7 million. This means that Duolingo is only expecting their revenue to grow by roughly 1.2% quarter over quarter, which is a massive deceleration to the business's revenue. So while the year over year growth rate looks very strong, the quarter over quarter growth is really starting to decelerate and taper off. Now, going back over to Duolingo's year over year bookings growth, we can see that it is roughly in the middle there at 22% year over year. And I found this next screenshot here on X, which shows Duolingo's total bookings percent change, and we can clearly see that the total bookings are starting to decelerate. In the most recent quarter, they were 33%, and again in the next quarter, it is projected to come in at roughly 22%, which will be an even further deceleration. Now, why this is a more bearish point is because the total bookings are seen as the future demand for Duolingo's business. You can kind of view it as like future revenue potential. So seeing the total bookings start to decelerate in such a big way suggests that Duolingo's future growth rates could also be decelerating, and there is not as much demand for their subscription services. Another chart that I found shows that Duolingo's paid subscribers growth rates are decelerating consistently, and in the most recent quarter fell down to 34% year over year. This is still a very strong growth rate, but it's clear that the business's momentum is starting to slow down, and I think that this is majorly why the stock has fallen so much. However, in the Q3 shareholder letter, the CEO wrote this: "In Q3, we decided to shift the balance toward longer term initiatives. In particular, we're investing proportionally more in teaching better, and we're prioritizing user growth over monetization in the A/B tests that get launched. This shift is reflected in our full year guidance." So what the CEO is saying is that Duolingo's focus right now is growing their overall user base, not necessarily growing their paid subscriber rate or trying to monetize their existing users. They just want to get and attract more people onto the Duolingo app. And this is being reflected in the total bookings, the revenue, and the paid subscribers all starting to decelerate. It sounds like the CEO thinks that this is the best thing for the long term of the business because they really just want to attract as many people to the platform as possible. And then I imagine that over time, they will want to monetize all of the new people that are on the app. But right now, the focus is just getting them there. So we're going to have to see how this plays out long term. Personally, I would kind of like to see this all happening in conjunction with each other, like what has been happening with Duolingo historically, because they have done a great job growing the overall user base, growing the revenue, growing bookings, and growing paid subscribers while still attracting more people to the app. So this does seem to be a slight shift in the business's focus, but we're going to have to see how it plays out over the long term. Because Mercado Libre, which is a stock that I own within my own portfolio, does do similar things, where they sacrifice short-term profitability or even short-term revenue to attract more people to their e-commerce platforms or to their fintech platforms, and then monetize them over the long term. So I have seen similar strategies within my own stocks, and I do also like when CEOs focus on the long term. But I do also have to admit that this is not the most bullish thing to see that the business is decelerating so much. So now let's talk about Duolingo's valuation. Well, in the trailing 12 months, the business has done roughly $365 million in free cash flow now, and it is trading for $8.770 billion today. That is its market cap. So if we divide this by $365 million in trailing 12 months free cash flow, then it means that the business is trading for about 24 times free cash flows today. Now, if Duolingo can continue to grow its revenues by over 20% annually from here, then I do actually think that the valuation is looking very fair and compelling. A 24 price multiple for a business that is growing its revenues from anywhere between 30 to 40% year over year is extremely compelling. The balance sheet of this business is also pristine, and their profit margins are extremely high. There is quite a bit of stock-based compensation going on with the business, which if you want to factor that in, then the price multiples do expand quite greatly. But overall, I do think that a 24 price multiple for this business is quite compelling if it can continue to maintain its high growth rates over the longer term. So then the ultimate question is, am I buying Duolingo here? And the answer is no. And the reason is because I am not personally confident in this business's moat, and I do not necessarily know for certain if the business is going to be able to maintain high growth rates over the long term. It looks like a fantastic business. Its metrics are absolutely insane. It's growing very quickly. But what matters in investing is having confidence that this level of growth can be maintained over the long term. And personally, I do not have that confidence in the business's long-term moat and potential to take a position in the stock and feel comfortable with it. That is just me as my own investor. But when I take a look at the financial metrics, there's no doubt they are insane, and the price does look quite compelling today. So that is my opinion on Duolingo, the stock today, and its earnings. All right, let's now move on to Shift 4 Payments earnings results, which the ticker symbol is 4. This is a stock that I have been covering on my channel for the past few months now. I have not yet taken a position in the business, but I do think that it is looking very interesting, and it is one that I do honestly just need to spend some more time researching so that I can gain more confidence in if the business has a moat or not. But regardless of the moat question, I think that Four's financials are looking extremely good, and its price today is looking very attractive. So let's dive in to the earnings results, and I took some screenshots here from the shareholder letter that I want to share with you. So this says, "Dear fellow shareholders, as you will see in the pages ahead, we had another reasonably strong quarter despite what I would characterize as a complex economic backdrop. Compared to the third quarter of last year, we grew gross profit 62%, gross revenues less network fees 61%, and at strong adjusted EBITDA margins of 50%. When excluding the impact of Global Blue, which was a recent large acquisition that the company just did, gross revenue less network fees grew 19%. Whether it be sitting on our hands growth of 19% or 61% when including Global Blue, or our most likely medium-term outlook when considering continued capital allocation, you should see that we are well on our way to delivering on our 3-year commitments. These results highlight the durability of our unique operating model. As we've said many times in the past, we have strong products that are uniquely positioned to serve large verticals, a capital allocation philosophy that prioritizes the maximum return on investment, and 3, an operating discipline to obsess over what can be improved. So right away, we can see that Shift4 grew its gross profits by 62% year over year, its revenues by 61%, and even on an organic basis, not factoring in their large acquisitions, revenue grew 19% year over year, which is still a strong growth rate. As I have shared in previous videos, Shift4 Payments is also a serial acquirer within the global payment space, and they have a strong track record of doing acquisitions that grow the per share profits of the business, which ultimately means that intrinsic value per share is continuing to grow. But let's continue on through the shareholder letter. And this says, in Q3 and early Q4, we experienced modestly worsening same-store sales from our restaurant and hotel customers, but increased contribution from new verticals and geographies. We remain on track to achieving our medium-term guidance levels of over 30% compounded annual growth rate. I will close by reminding you all that capital allocation is a core competency of our business. This forces us to prioritize where the next dollar is spent, and with urgency, as the free cash flow of the business improves each quarter. Our own equity fluctuates, often as a result of what our competitors are doing, as opposed to our own results. To this end, our board has authorized a new $1 billion stock repurchase program, which is the largest in our history. So what the CEO is saying in this screenshot is that the business is still well on track to achieve their 30% compounded annual growth rate guidance over the medium term, which is the next few years. Then they also say that they believe the share price of Shift4 Payments is down because the market tends to focus on what the payments processing space as a whole is doing. And you can think about this like Shift4 Payments tends to trade in the short term based on what a competitor like PayPal may be doing, or at least what PayPal's stock is doing. So Shift4, again, in the short term, is not necessarily trading or reflecting the underlying business's fundamentals and what the fundamentals are doing. Because in my opinion, it's pretty clear that Shift4's fundamentals are growing extremely well. And because the share price is not necessarily reflecting the underlying fundamental growth, the business has authorized a $1 billion share buyback program now. So we're going to have to see if they actually launch the buyback cannon and start buying back shares aggressively while they believe their stock is significantly undervalued. Moving on to the next screenshot, this one says, performance highlights for the third quarter of 2025. The business saw 26% year-over-year growth to Q3 volume, again 62% year-over-year growth to gross profits, 61% year-over-year growth to revenues. Gross revenues also came in at $1.176 billion, up 29% year-over-year. Gross profit came in at $410 million, and gross revenue less network fees came in at $590 million. Then they also say that net cash provided by operating activities was $172 million, and adjusted free cash flow was $141 million for the third quarter, which is up 21% and 27% respectively from last year. So Shift4's operating and free cash flows are also growing by over 20% year over year. It does seem like there was some cash flow margin compression because, again, the revenues are up 60%, but the cash flows only grew by 20%. And this could be due to some acquisition costs or some integration costs with the massive acquisitions that they have done so far in the year. This next screenshot gives us a zoomed out view of the company's KPIs. We can see that the company's Q3 payment volumes have compounded by 42% since 2021. The 4-year compounded annual growth rate to gross profits is sitting at 63%, Net income and adjusted EBITDA are also sitting at all-time highs, and operating and free cash flows are both sitting at all-time highs for a single quarter as well. So it seems like the business's fundamentals and its KPIs are continuing to grow in the right direction, and this is overall great to see for the business. Then Shift 4 shows us that they are continuing to expand market share within their hospitality vertical, and they have had some pretty major signature wins in the third quarter. They say that Shift 4 has partnered with Hyatt Vacation Club to power payments for their 20 plus resorts in beautiful, hand picked vacation destinations across the globe. So Shift 4 is continuing to expand their market share and win major new customers. They then gave a restaurant update where they say Shift 4 continues to gain market share in restaurants, winning new restaurants every day. And then they show that they're winning restaurants in the United States, Canada, Germany, and over in the UK. So Shift 4's global expansion seems like it is continuing to be quite strong, and they're gaining market share around the globe. So now let's head over to Stock Unlock really quickly and take a look at Shift 4 payments-based revenue. And we can see that in the most recent quarter, this was a massive revenue quarter sitting at 1.06 billion. And we can see that over the long term, the company's revenue has been compounding by 36%. In the trailing 12 months, we can also see that revenue is growing very strong and had a meaningful uptick in the most recent quarter. So it seems like revenue is continuing to grow, all of the KPIs are continuing to grow, cash flow is continuing to grow, and they are on track of meeting their medium-term guidance of compounding the business by 30% annually. Now, what's interesting is the market cap of this business is sitting at $6 billion right now. In the trailing 12 months, it is trading for a price to free cash flow of only 15, and the business is projecting to produce roughly $500 million of free cash flow in 2025. So if we go $5.83 billion market cap divided by $500 million roughly in free cash flow produced for this year, then that means that Shift 4 is trading for a price to free cash flow of roughly 11.7 right now. And again, this is a business that is projecting to compound its fundamentals by 30% annually over the next few years. What's also interesting is they just announced a massive $1 billion share buyback program. So if we go 1 divided by 6, then this means that if they actually execute on buying back $1 billion worth of shares and their stock price does not go up from here, then that would result in a share count reduction of roughly 16.7%. So this is a massive share buyback. It will probably have to be funded by debt because the company is only producing roughly $500 million in annual cash flow right now. So yeah, if they do actually execute on this, then they probably will leverage up the balance sheet a little bit. But still, I think that a 12 price multiple for a business that's projecting to grow by 30%, it's growing organically by 19%, it's continuing to take market share. It seems like it's doing accretive acquisitions. In this quarter, including its large acquisitions, it grew by 60% year over year. So it just seems like the price multiple is not reflecting the underlying fundamentals of the business and its future growth rates. So for some reason, the market seems like it doesn't have conviction or faith in the future growth potential of Shift 4's business. But if the business can continue to execute over the next few years and over the long term, then I think the stock is looking absolutely ridiculously cheap today. So my question really centers around, why is the market being so bearish towards this business? Why doesn't the market have faith in the future potential of the company? And also coming to a definitive conclusion on what the moat of this business is that is allowing it to fight off competition and continue growing over the long term. So I'm not sold on the business yet. I'm not buying shares right now, but I do think the stock is looking extremely interesting, extremely undervalued, and I'd really just need to continue doing a little bit more research. But I do want to put this one on your own radar if you want to do research and come to your own conclusions, because yeah, it looks very compelling to me. Now, the last stock that I want to talk about in this video is Brookfield Asset Management. They just reported their earnings this morning, and it looks like the stock did not respond well from what I recently saw. Let's see if it's up on the day yet. No, it's still down roughly 0.45%. Looks like it might be down another 1% in after hours. So it seems like the market is not necessarily responding well to Brookfield Asset Management's earnings so far. So I went through the earnings really quick, and I have some screenshots that I want to share. Here we can see that Brookfield Asset Management reported record quarterly earnings performance. They had $754 million worth of fee-related earnings. Fee-related earnings grew 17% year over year, and the fee-related earnings margin was 58%, which is basically a 58% profit margin, which is insane. The company also had record organic fundraising, deployments, and asset monetizations. They raised $30 billion in the quarter, they deployed $23 billion, and they monetized a total of $15 billion worth of assets. In the third quarter, they also acquired the remaining 26% stake of Oaktree that Brookfield Asset Management did not already own. And I think that this is a very, very bullish thing for Brookfield as a whole. Oaktree was founded by Howard Marks, who is considered to be a legendary investor. And I've talked about this before, but Howard Marks said that he was not willing to sell Oaktree to just any company. In fact, he wasn't even looking to sell the company at all. But then when Brookfield came along and put in a bid, he thought that Brookfield had the reputation and was a very high quality company, and it was a business that he was willing to sell to. He wanted to make sure that Oaktree had a very solid home, and I think that speaks volumes to the quality of Brookfield's overall business. And I also think that it is very bullish that Howard Marks, who is again this billionaire legendary investor, is now 100% owned, in a way, by Brookfield. So I just think that's really cool because I look up to Howard Marks highly. Now, another major bullish point is in regards to Westinghouse. Westinghouse announced an $80 billion partnership with the United States government to develop new nuclear power plants across the United States, which we are going to talk about later on in this video, but this is massive for Brookfield. Moving on to the next screenshot though, we can see that fee-related earnings once again came in at $754 million, up 17% year over year for the third quarter. And in the trailing 12 months, fee-related earnings came in at $2.8 billion, up 19% year over year. So Brookfield Asset Management's fee-related earnings are growing very strong. However, distributable earnings came in at $661 million, up 7% year over year. And for the trailing 12 months, they are up 12%. It looks like distributable earnings were impacted quite significantly by cash taxes paid, and cash taxes increased by 41% year over year. And if I had to guess, the distributable earnings only growing by 7% year over year is probably why the market was not super bullish on the earnings report. But I think that this is probably just like a one-time larger cash payment that they had to make in the quarter. And going forward, I would imagine that distributable earnings will grow in line with fee-related earnings. All right, now let's move over to the Q3 conference call transcript. And this is from Connor Chesky, who is the president of Brookfield Asset Management now. And he says, over the past 12 months, we've raised $30 billion, deployed $30 billion, and monetized over $10 billion at approximately 20% returns, demonstrating strength, scale, and the consistency of our platform. And I wanted to highlight this because it's continuing to show that Brookfield is able to invest significant sums of money at very high rates of returns. Again, they just monetized over $10 billion worth of assets at an over 20% return rate, which is phenomenal. Moving on to the next screenshot, he then says, we estimate that AI-related infrastructure investments will exceed $7 trillion over the next decade. Brookfield's unique position, owning and operating across the full energy and digital infrastructure value chain, gives us a tremendous advantage in capturing this opportunity. So Brookfield believes that over the next decade, there will be over $7 trillion spent on supporting the infrastructure build-out. This is everything from digital infrastructure to energy infrastructure to the actual compute of artificial intelligence. And Brookfield, in my opinion, I agree with what they're saying right here, is uniquely positioned to benefit and capitalize on this massive global infrastructure build-out opportunity because they have decades of experience not only managing these assets, but building them from the ground up and operating them extremely efficiently. So I think that Brookfield is one of the best positioned companies in the globe to actually capitalize on the build-out of artificial intelligence and all of the infrastructure that is needed to support this transition. Moving on through the transcript, this says, we are very pleased to announce last week a landmark partnership with the US government to construct $80 billion of new nuclear power reactors using Westinghouse technology. The agreement reestablishes the United States as a global leader in nuclear energy and positions Brookfield at the center of a historical build-out of clean baseload power, creating one of the most compelling growth opportunities across our transition platform and potentially one of the most successful investments in Brookfield's history. So I don't know how many of you saw this major news announcement over the past couple of weeks, but yeah, Brookfield signed an $80 billion agreement with the United States through Westinghouse, which they own 51% of. Cameco owns the other 49%. But Westinghouse was chosen by the United States government to build out $80 billion worth of nuclear reactors across the United States. And I think that this speaks volume to the overall quality of Brookfield's business once again, and the fact that they own one of the best nuclear energy companies in the globe. and that the United States chose Westinghouse to partner with. So again, I just think that all around, this speaks volume to Brookfield's business. Moving on to the next screenshot, this one says, these drivers should enable us to double our business over the next 5 years, with fee-related earnings reaching 5.8 billion, distributable earnings reaching 5.9 billion, and fee-bearing capital reaching $1.2 trillion. However, our business plan does not include certain additional growth opportunities, such as product development, mergers and acquisitions associated with our partner managers, and an opening up of the 401k market opportunity, which gives us multiple paths to outperform and to deliver over 20% annualized earnings growth. So Brookfield Asset Management is projecting to double their overall business over the next 5 years, but they're also saying that this projection does not factor in potential acquisitions and potential new markets that are opening up, like the ability for 401ks to invest in private assets. And with acquisitions and these new markets opening up, they believe that they can grow their earnings by over 20% annually over the next 5 years, which is a very bullish projection. So I did a quick discounted cash flow calculation here over the next 5 years, saying that Brookfield Asset Management can grow its distributable earnings by 20% annually, also grow its dividend by 20% annually, and trade for a 25 price to free cash flow, which I think is very fair for this business. And if Brookfield can achieve their own guidance of growing by at least 20% annually, then the stock could compound by roughly 16% from here, and the fair value is around $69 per share US. So if Brookfield Asset Management can achieve these results and actually grow the business by 20% per year from here, then the stock is looking undervalued and could offer a market-beating return. Overall, I do think that this was a pretty good report from Brookfield Asset Management. I think that the market may be a little bit concerned that the distributable earnings did not grow with fee-related earnings. But again, I think that over the long term, these two growth rates will match each other and, level out. I just think that this was kind of a weird quarter where they had more cash taxes to pay. That being said, I am still preferring Brookfield Corporation over Brookfield Asset Management at their respective share prices today. So I personally am not purchasing any BAM in my portfolio, and I still do prefer to buy more BN at the current share prices. This is simply because BAM is much more focused on paying a dividend. We can see that their dividend yield is much higher, and Brookfield Corporation is much more focused on reinvesting all of their capital into growth. And for that reason, BN is projecting significantly higher growth rates over the longer term. And funny enough, it's also trading for a lower multiple today. So basically, BN has more future growth potential, and it is offering a better price today as well. And that is largely why it is the largest position in my portfolio and why I prefer it over BAM still. But once again, I do still think that these were very solid results from Brookfield Asset Management, and I cannot wait to go through Brookfield Corporation's earnings next week when they report. All right, let's now move on to the final segment of the video, where I want to talk about what I am seeing in the market, some of the trends that I am noticing, and also share some data and what I am doing in my own portfolio now. I also do want to apologize that my camera is off. I couldn't finish the video on Friday, and I am now recording this on Sunday morning, and I have not showered or anything, and I'm just trying to get this video out as quickly as I possibly can. So I want to first start off this section by showing a couple of screenshots that I found recently. So this one right here says a divided US stock market. Tech companies with no revenues or profits are flying, as are the Magnificent Seven. The rest are left in the shade. Then we can see the average year-to-date performance of companies in each category by price return, and the companies in the NASDAQ that have no revenues are up the highest at an average of 34% year-to-date returns. Next is the Magnificent Seven with an 18% year-to-date return, and then unprofitable companies in the NASDAQ are up 18% year-to-date, or matching the Magnificent Seven. Unprofitable US small and mid caps are up 12%, NASDAQ companies with no revenues are up 11%, and then the S&P 493, which is excluding the Magnificent Seven, is only up 8% year-to-date. Then profitable NASDAQ stocks are up 7%, and profitable small and mid-cap stocks are only up 5%. This chart is showing us that if you wanted to outperform the S&P 500 in 2025, then you basically had to own companies with no revenues, no profits, or are the Magnificent Seven. And if you are not investing in these types of companies, then there is a good chance that you are underperforming the S&P 500 so far this year. I found another chart right here that says the number of companies outperforming the S&P 500 annually. So this is the number of stocks within the S&P 500 that have outperformed on an annual basis. Then we can see in 2023, it was 148 companies. Then in 2024, it was 152. We don't actually have the data for 2025 yet, but I imagine that the data for 2025 is actually going to be even lower. The long-term average is 239 companies within the S&P 500 do outperform the overall index. This basically means that over the past few years, there are less and less companies that are outperforming the S&P 500 as a whole, which does suggest that it has become more and more challenging to outperform the index as a whole, if you are a stock picker at least. Now, what I also found interesting is we are starting to approach the ranges of 1998 and 1999, where the market was getting more and more concentrated and it was getting more challenging to outperform the overall index. This ultimately means that the outperformance is continuing to get more and more concentrated. So again, if you are not invested in the stocks that are hot, outperforming, or are in favor this year, then it has been a pretty tough year for you. And I have seen this with a lot of investors that I personally respect and follow even on X. There's a lot of people that are investing in quality companies that are necessarily not the hottest stocks right now, and they have seen a challenging year as well. For example, if we take a look at Adobe, it's now trading for $327 per share, and its price to free cash flow is only 14 now. But if we go and take a look at its financials here really quickly and take a look at its revenue, then we can see that its revenue is continuing to grow extremely consistently and hit fresh all-time highs. So it's very clear that Adobe stock is out of favor right now because it is seen as a business where AI is going to disrupt it, and that is causing investors to not want to own the stock at all and instead move their money into the clear AI winners like Nvidia, TSM, Microsoft, etc. I'm also seeing people move a large portion of their money into the newer speculative stocks like Iron, which I think are extremely speculative. And I'll just continue listing some companies that are being absolutely decimated. As we saw earlier on in the video, Duolingo is now down something like 60% from its peak, despite it continuing to grow its revenues by roughly 40% year over year. And this is partly because, the company's outlook for the next quarter is kind of weaker, but also because people think that artificial intelligence is going to disrupt this business by people being able to learn new languages by asking ChatGPT and Google Gemini. So there are AI fears in regards to Duolingo's business, and that is partly why the stock is down so much. Even stocks that do not necessarily have this AI disruption risk, or not nearly as much, like DoorDash, are seeing their stocks fall significantly. DoorDash, just over the past month, is now down roughly 30%. And this company just reported another really good earnings report. I do think the stock was arguably overvalued, but we're starting to see businesses where they report strong earnings reports, strong numbers, and their stocks are just being decimated. Now let's move on to Constellation Software because it just reported its earnings on Friday after the market close. And we can see that Constellation Software is now down 35% from its all-time highs, which is actually the largest drawdown in the stock's 20-year history now. I do think that this is partly because the stock was as expensive as it has ever been. It was trading for about 35 times free cash flow at the peak here. So I do think the stock needed a correction, and I think that this is partly why the drawdown is as large as it has ever been. But if you go on social media, you will also see that so many people are nervous about Constellation Software being disrupted by artificial intelligence and new software companies spawning and taking their market share essentially. However, here I have the highlights from Constellation's most recent earnings report, again that they announced on Friday after the close. And we can see that revenue grew 16% year over year with 5% organic growth to $2.95 billion. Operating cash flows are also up 33% year over year, and free cash flow is up 46% year over year. So at least right now, it seems like Constellation Software's business is continuing to grow extremely well. The top line is growing very fast. The bottom line is growing even faster at 33% year over year. And it seems like artificial intelligence is not disrupting this business, at least not yet. And if we go take a quick look at Constellation Software's revenues, we can see that over its 20-year history, every single quarter, it has been growing its revenues in the trailing 12 months, and that is still happening today. The business is continuing to scale, grow at very nice growth rates, and it seems like the investment thesis with this business, at least right now, is still intact. And due to Constellation's share price falling by roughly 35% despite its cash flows continuing to scale, it has caused its price to free cash flow to drop all the way down to 20.8. We do not have the most recent quarter in stock unlock yet because it was just announced a couple of days ago, but Constellation's trailing 12 months price to free cash flow is actually below 20 now. And if we take a look all the way back to 2015, we can see that the median has been roughly 24, the average has been 24.7, and again, the most recent value now is 19. So Constellation Software is now trading well below its long-term historical average price multiples, again, because the company's fundamentals have continued to grow extremely well, but its share price has fallen quite significantly. And this is a good example of how in the short term, the market is a voting machine. And right now, the market is voting that all of these software stocks like Constellation Software, Topicus, Adobe, even CRM are not good businesses because they have AI disruption risk. Or at least investors are voting that these companies are going to be disrupted by AI. But when we take a look under the hood at the fundamentals, at least right now, they are continuing to grow. And I also don't necessarily believe that these companies are definitively going to be disrupted by AI. I actually give it roughly a 50-50 chance right now that a small portion of their businesses could be disrupted by AI. But I also think that these software companies could benefit from AI and use it to increase efficiencies, expand their margins, develop new products that they can then sell, and potentially increase organic growth by doing so. The market seems to be overly bearish on every company that is not a pure play AI business like Microsoft or even the new data center builder companies like Iron and CoreWeave, while at the same time, they're continuing to pile more and more money into the Magnificent Seven and unprofitable companies or even companies that do not have revenue. So this is a very strange market, but what I am continuing to do is focus on the fundamentals of the businesses that I own and the fundamentals of businesses that I potentially want to invest in. Like Constellation Software, for example, I am actively buying this stock again in the market for the first time since 2022 because I believe that a 20 price to free cash flow, it's actually at 19 now, is extremely fair for a company that is continuing to grow its top line by 16% and its bottom line by an even faster rate. And I also believe that AI is not going to disrupt this business in a meaningful way and is going to be able to continue compounding at these growth rates for the next 5 years and potentially over the long term. And while the market is selling off this stock, it means that I am getting a better price multiple on cost, which ultimately means that the future returns of every new dollar invested will be higher. And that is how I am thinking about my portfolio. I am trying not to be distracted by what the S&P is doing or which stocks are hot in the market, and I am not going to increase my risk by piling into what is currently working, which is the expensive stocks in my opinion, and the businesses that are extremely speculative. And again, I do not want to lower my risk to chase what is currently working. I want to just stick to what I know, which is buying high quality businesses at reasonable prices. And if the fundamentals are continuing to grow and are remaining solid, but their stock prices are coming down, then I am trying to take advantage of that by continuing to buy more and more. But overall, it has been a challenging year for many quality investors, myself included. And I just wanted to give an update on how I am thinking about that, what I am seeing, and how I am currently deploying capital in my own portfolio. But with that being said, that is going to wrap up today's video. And once again, my course sale is going to start tomorrow, my Black Friday sale. So if you want to get notified, then please click the link at the top of my description. It will take you over to my website and you can enter in your email there. I will be sending out an email tomorrow morning when the sale goes live, or you can stay tuned to my channel because I will also be letting people know in future videos. But this is going to be the largest sale on my investment course for the entire year. So there is no better time to pick it up if you have been considering getting it, and I will be letting you know throughout the week as well. But with that being said, thank you all so much for tuning in. I truly do appreciate it, and I hope to see you all again in my next video.